198.50 points. That is a massive number, because at exactly 2:32 p.m., without any warning whatsoever, the Dow Jones Industrial Average just went into a vertical dive. It plummeted almost 1,000 points in a span of just 20 minutes. At the time, this was the largest one-day point decline in history.
Today, we're going to dive into what is basically a digital true crime thriller. We're looking at the terrifying afternoon of May 6, 2010. For anyone watching the financial tickers that day, it literally felt like the entire US economy was vanishing into a void. It's a crazy story of rogue algorithms, massive unintended consequences, and the day the machines completely took over our financial markets.
So regulators later identified 5 distinct phases of this crash. Tracing the timeline, we start with a broadly declining volatile open, which moves straight into phase 2 at 2:32 p.m., where that decline rapidly accelerates. By 2:41, we hit phase 3 with massive volume spikes and a sudden 5 to 6% plummet. Then extreme price fluctuations hit at 2:45, and finally, a chaotic but surprisingly orderly recovery by 3 p.m. It was a lightning-fast descent that left human traders completely paralyzed, scrambling to figure out what on earth was breaking the system.
The massive E-mini spark. So how does an entire market just break? Let's look at the catalyst. Well, regulators spent months digging through the data, and they ultimately traced the whole thing to a single source, a Kansas-based mutual fund manager. They used an algorithm to sell 75,000 E-mini contracts. And if you're wondering what those are, they're essentially specialized electronic bets on the future value of a stock index, like the S&P 500. This single massive trade was a $4.1 billion spark, introduced right into a highly volatile ecosystem.
Now, just think about the extreme contrast in execution time here. Normally, if a human trader would execute a massive trade of this size, they'd carefully space it out over about 5 hours, right? Gotta ensure they don't spook the market. But the mutual fund handed this task over to an algorithm, and this algorithm dumped everything into the market, saturating it in a mere 20 minutes. That speed completely overwhelmed the natural buying demand.
So why did it act so fast? Well, the code was brutally simple and honestly, totally flawed. As the official SEC report noted, the algorithm was instructed to dump the assets without regard to price or time. Basically, this meant it just kept aggressively selling its massive block of contracts, even as market values were sharply dropping. It was completely blind to the absolute panic it was causing.
The hot potato effect. This relentless blind selling confused the other machines in the ecosystem. As detailed in the SEC findings, the mystery really deepened as high-frequency trading, or HFT algorithms, detected the initial drop. You'd think these super sophisticated machines might step in to provide stability or maybe buy up cheap assets, right? Nope, they panicked too. They began aggressively reselling the exact same futures contracts to one another, which drastically accelerated the selling pressure.
The SEC actually described this as the hot potato effect. These algorithms were tossing these contracts back and forth, frantically changing hands 27,000 times in just 14 seconds. Seriously, 14 seconds. It created a feedback loop that entirely outpaced any possibility of human intervention. But here is the really crucial point. Out of those 27,000 rapid-fire exchanges, only about 200 actually resulted in a real change of ownership. The vast majority of these trades were just the algorithms essentially screaming at each other in an infinite loop. They were continuously buying, canceling, and reselling the exact same assets while the whole market burned around them.
The 1-cent share. As this digital panic rippled out from the futures market into the broader stock market, logic completely vanished.
This is where things get truly absurd. Because of the algorithmic chaos, shares of Procter & Gamble, which is traditionally one of the most stable, reliable blue-chip companies in the world, briefly plummeted to a trading price of just 1 single cent. Imagine buying a share of P&G with a penny you found on the sidewalk. And at the exact same time, other individual stocks inexplicably soared in the total opposite direction, hitting absolutely absurd prices of $100,000 per share. The pricing mechanisms that ground the market in reality had completely broken down. They were just caught in the crossfire of warring algorithms.
Faced with data that made absolutely no mathematical sense, stocks trading for pennies or hundreds of thousands of dollars, many automated trading programs did the only thing they could do. They just shut themselves down. And by pulling out, they completely evaporated all the liquidity that the market desperately needed to cushion its fall. Literally, there was no one left to buy.
Fixing a fragile future.
Now, let's talk about the aftermath.
Remarkably, the market magically recovered about 347 points before the closing bell that very day, basically self-correcting. But the damage to ordinary investors' trust, that was permanent, and it forced immediate regulatory action. To prevent rogue code from ever taking down the system like this again, the SEC stepped in. They permanently adopted the market access rule, and they implemented temporary safeguards like single stock circuit breakers and limit up, limit down rules.
Let's talk about those circuit breakers, because they essentially act as an emergency brake for the market. If the system detects a stock moving up or down by 10% within a 5-minute window, trading is automatically paused for that specific stock. This mandatory cooling off period gives human traders and the market itself a critical moment to just stop, absorb the shock, resolve the uncertainty, and figure out what is actually happening.
However, these solutions weren't universally praised. The market access rule controversially allowed high-frequency trading firms to essentially self-regulate their own safety measures. As you can imagine, this drew heavy criticism during subsequent congressional hearings from experts who felt regulators were giving way too much power to the exact same entities that were causing the volatility.
During those hearings, market structure consultant David Lauer brilliantly illustrated the danger of this approach. He compared the SEC's reliance on HFT firms regulating themselves to the fox guarding the henhouse. He pointed out that high-frequency traders will always be tempted to exploit their immense speed advantages to the detriment of the ordinary investor, making self-regulation highly risky.
And this contrasts sharply with how other nations responded. While the US has relied mostly on those circuit breakers to maintain order, international regulators in Germany and Canada took a much harder stance. They actually imposed physical speed limits on trade execution. This was done to level the playing field, ensuring algorithms aren't given a radical time advantage over ordinary human investors.
The flash crash of 2010 proved definitively that our financial market is no longer just a human arena. It is a lightning-fast ecosystem of algorithms that can break in the blink of an eye. So, looking at the regulatory path we've taken, it leaves us with a really critical question to ponder. Despite the circuit breakers, is our financial system still just one line of rogue code away from another disaster? Thank you so much for joining me for this explainer. I hope it helped you visualize the incredible, invisible speed of modern finance.